With me now from New York is McCarthy, the chief financial economist at Jefferies Co, also a doctor of economics and a former monetary policy advisor and chief of bank studies at the Federal Reserve Bank of Richmond. So very qualified indeed. Thank you for joining us this evening from New York, Mr. McCarthy. I must ask, if I can, first of all, this jobs data today, how important is it again? It's always important every month, but again, for example, the consensus figure is for a figure of 185,000 in April. But SocGen say it'll be double that, at 325,000.
Well, SocGen's taking a very strong position. I should also point out they're, I think, pretty much alone on that front. Actually, because of some other data that was released over the course of the week, I actually revised the Jefferies forecast lower. So we're looking for now a gain in total non-farm payrolls of 150,000 and 165,000 in the private sector. And the contributing factors to that were some deterioration in the employment indices of both the service and manufacturing ISM index, as well as ADP data that came in a little bit weaker than last month as well. So it's still a decent number, but I don't think it will be as robust as we had in March.
With the U.S. economy as it is, Dr. McCarthy, do we see that the Fed will really be quite nervous about these numbers?
Well, I think the Fed Chairman Bernanke last week made it very clear that the number one priority at the Fed is jobs. They want to see the unemployment rate come down. They want to see job growth. And they will be looking at it, I don't know, nervously, but certainly with great interest, because that is the primary target of monetary policy right now. However, there also was another event today that I suspect made the Fed chairman breathe a sigh of relief, and that is the collapse in the commodity markets, because he has been taking some heat in the U.S. for not taking action against an increase in inflation, but that increase in inflation has been exclusively driven by commodities here. So that's going to take a little bit of heat off of him, and I think he'll be more comfortable at least with that development.
And the reaction for that was, of course, the US 30-year to rise for 6 days, the longest winning streak, I believe, since December 2008. 10-year yields falling to a 6-week low, all because, of course, that flight to the US bond market again. Is it a new trend, therefore? Is the US Treasury market really going to see a lot of interest now?
Well, to be honest, I think that this rally is getting close to having its last legs. A combination of factors have caused the bond market to rally in the U.S., and the most noticeable was the fact that economic data has softened since the terrible earthquake and tsunami in Japan, and the primary link there are supply lines to the U.S. In fact, the Bureau of Labor Statistics this morning, when they were discussing the rise in jobless claims, noted that part of it was due to plant closings, that the shutdowns being attributed to the breakdown in some of the supply lines from Japan. So, you know, that has been a little bit of a problem. However, also underlying the rally in the bond market has been the fact that investors in the U.S. have been short, and primary dealers in the U.S. have been outright short the Treasury market. As recently as a week ago, they were as short as they had been at any time since 2008, when shorts were at a record as well. So I think it's a combination of fundamentals that became a little bit more favorable to the bond market, and short positions that just forced investors and primary dealers to cover their shorts had a lot to do with why this bond market rally was so strong.
I must ask you this. You're also the former chief financial economist of government debt research at Merrill's. The U.S. is close to its $14.2 trillion debt borrowing limit, that Fed debt ceiling. California's deficit is $26.4, I believe, billion. Illinois State, New York State again. The debt issue is absolutely enormous, and obviously that's a big worry for Bernanke and also the Secretary, Tim Geithner. I mean, how do you perceive this with your vast experience of PhD in economics as a problem going forward for the rest of the world?
Well, the U.S. has a serious debt hangover. there has been much too much reliance upon debt at every level of government except the local level, which is pretty much a cash business. And of course, U.S. consumers relied very heavily on debt, or at least leveraging, for example, homes, in order to foster greater spending. So all of this was a major contributor to the recession that we had and the financial crisis. And I think that the legacy of this is that the U.S. will continue to grow, but we're going to have moderate growth here. It's going to take a while.
I'm sorry, time is against me. Thanks for joining us this Friday morning.